start this formally. Yeah.
Okay, we are recording now.
Here we go. Yay, we got the technology to work. Yay.
So, hi everyone, welcome to the BCCIC webinar on how to survive the Global Affairs Canada audit. We have Michael Simpson here, who is the Executive Director of BCCIC, and he had his own NGO in a past life called One Sky, I believe. And so he has survived many audits already and is here to bestow some knowledge and some tips on those who are looking for that information today in this hour-and-a-half, I believe, long webinar. So if you have any questions, please feel free to use the chat box. If you see at the bottom of your screen, there's a little icon that says chat. You can pull that up. I'll be watching the chat box for any of the questions that you have, and I'll let Michael know what those are. And you can also let me know if you're having any technical difficulties, things like that. So without further ado, I will hand over the floor to you.
Super. I guess we can check and we can see ourselves in that recording. We've got a bunch of screens and a bunch of things going on here because we're going to get technical and show you a bunch of living documents so that we can actually try this. All exciting stuff with this conference technology. So why don't we start out with my disclaimer. If you haven't seen some of our other, get that to work. There we go. Go back. Disclaimer. The disclaimer looks like it's actually a resume, but if you think of it, I've been audited 19 times. That could be a good or a bad thing, depending on how you wanted to look at it. So I've been audited for project audits, about 19 project audits through One Sky. I've gone through a whole bunch of organizational audits with other organizations as a board member. And I've also gone through a BCCIC midterm financial audit as of August a year ago or so. And the good news on this is that I've learned a lot. And that's what the idea was that people kept saying, could you do a workshop on this? Because you seem to have been through enough of these audits that you could share some of your knowledge. So the disclaimer though is that it's all just an opinion. I was also audited through the CRA when I used to run a private company. And I've been through at least 18 what are called CPA audits or Chartered Professional Accountant audits. Those are the annual audits that you would get done every year in your organization if you were doing that, using that methodology. So I'm going to go through this slowly. If you have questions, it's really smart to bring them up as we go, and you can chat by typing them in, and Diane will keep a record of those. And we can either answer them at the end, or if it's a question that's coming up about something that I'm saying for clarification, don't hesitate. Just type in, and we will try to tackle it as we go. And I'm going to have to move fairly quickly. So if something's not 100% clear, we can get. You could do a whole 20-part series on audits. So I'm going to try and go through and get to the juicy part, which is what are the common mistakes that I've found or that I've learned over the years and how you might avoid them. And I do just want to stress the bottom bit about this. I am not an accountant. I'm not a bookkeeper. I'm just a person who's gone through a lot of audits, willing to share that knowledge with you. So don't take what I say as official opinion. Indeed, the only person that is sort of the ultimate authority when it comes to audits is your funder. And funders vary. What I've learned over the years is that even the same funder will tell you one thing one year, and the next year they'll have a whole new opinion as if it was always that way. And that I've also found to be both irritating, frustrating, but it's the name of the game. So the only final authority on all of everything that's being said today is ultimately going to be the person who gives you that money. And just before we dive into the details, I promise there's going to be lots of details, but a little bit of philosophy. A book that I have found incredibly useful over the years was written in the 1970s by an old hippie, Michael Phillips, who actually started MasterCard. I highly recommend that you read it, especially if you're going to go through an audit, as you will orient your mind towards taking all of this with a bit of sense of wisdom. And it's called The 7 Laws of Money. It's exceptional. I found it changed my entire life. Many, you read it 25, 30 years ago. And it's been a very, very useful book to understand money as a vector, and that the process of an audit is essentially an exercise in trust. So let's talk about what can go wrong, just so we can set the tone as to why we're doing this in the first place. What I found is that the time involved in doing an audit can be huge. It's not a matter, people think this is going to take a few days, the auditor's going to come. They can draw this stuff out into months. I've had one audit that took, like, literally they were at it for 6 months. Just kept wanting to look at this or look at that, and time goes by and you got to go and search for this. And sometimes you can't find those audit expenses, or they're not recoverable because they're sitting in Nigeria or some other country, and so it can become a real pain. So, and it's also the kind of thing I would not underestimate the stress. It depends on your character, and we'll talk about some of the things you can do to cope about the stress of an audit, but it's definitely stressful. and that these disallowed expenses can add up. So a disallowed expense is something where the auditor is going to go through your books, look for a receipt, can't find the receipt, says that's a disallowed expense, and you're expected to pay that back to the funder. And those expenses can add up. I've seen organizations with 80, 90. The worst case scenario I've seen so far is $310,000 worth of disallowed expenses, and that can sink you. That can sink you as an organization. The other one with audits is they seem to be a way where they just hit you when you're at your most busiest, or it's the summer or it's the Christmas holidays. Once had an auditor phone up on the 21st of December and ask for audit information and a whole slew of information, and they wanted it by the 23rd of December. So that's the kind of thing where it just always comes at the wrong time. And if you can plan for an audit, then when that request comes, it's not going to take you by surprise. This other point that I'll point out is a lot of people don't realize that you can finish a project, and you spent your $300,000 in Uganda or wherever, and you finish it off and you send in your final report, they send you the whole back, everything's done, call it a day. They can for up to 3, and in some cases I've been audited up to 5 years after the project is long finished and gone. And that, in case you haven't thought about that, is your ultimate nightmare, because they can come long after the project's finished, disallow $20,000 in expenses, and you're liable for that. And they can actually freeze your funding, take you to the courts, demand they get the money back, and ultimately, if you don't have it, it's your board of directors that must pay. And that's something a lot of organizations and board directors don't understand as well. Without directors' liability insurance, you personally are going to have to pay that money back as a board director. So it's something where if you go through financial risk assessments and so on, they will look at the chain of command to understand whether the board of directors understands that, et cetera, et cetera. So those are a few things just to keep in mind around the ultimate nightmare nature of these audits. Having said all that, it's incredibly important that you understand also it's not just about the receipts. Really what they're looking at in a good audit is the level of accountability about trust. And like I said, money is just a vector. Money itself is, they give you money, but as the 7 laws of money says, nobody ever gives you money. It's a contract, and you're expected to do, if they give you $500,000, you're expected to do $500,000 worth of work. And they will check, and that's the idea. It's how can we set up these systems to check. Now, the average project cycle goes like that. You sign a contract, you agree you're going to do some work. They're going to give you in advance a bunch of money, and then you're going to go spend the money, collect the proof. It's in the form of receipts. You're going to report on that in a quarterly or a semi-annual way. That is not an audit. That's just a report. And then you'll get more advances because they like the report. Finally, you're going to get a holdback, and then you think the project's over. And literally, the third-party audit, there's 2 kinds. There's one that's going to happen in the middle of your project, a midterm, or a partially way through your project, and you want to welcome those. And then there'll be a final audit if they decide to do it, which is going to be to look at how you spent the money after all the project funds have been spent. And then they'll disallow a certain percentage of expenses, and you'll have to pay that back. Or you're going to come through with a remarkably clean audit because you're doing everything right, and you won't have to pay anything back, which is incredibly rare. So ideally, what you would get is a pre-audit visit. That's before, so you sign the contract and you get the auditor comes and visits you and say, this is how we're going to hold you accountable. Here's the set of rules, and they explain those rules really carefully to you. That's ideal. You want that. If they actually want to do that, welcome it, bring it into your organization. Ideally, you want to have a midterm audit, and you might say, oh, I don't want an audit, but you do want a midterm audit, because a midterm audit is going to allow you to fix the mistakes you've been making. So if you haven't been timesheeting properly, fix it immediately in the midterm audit so you can recover your expenses, so that when the final audit happens, you're not going to get stuck. Because the problem with the final audit is the project's over, you can't fix anything anymore. So if you did something wrong, you're going to have to pay the money back. So you want to kind of think that the pre-audit and the mid-audit visits, if you can encourage them, you want to encourage them. And I wrote on the bottom of this slide, you can influence this by taking this into your own hands by requesting them. And it seems going to be weird. You want us to audit you? You say, yeah, I want you to audit. I want you to come, check us out, see if we're doing the right thing. And I highly recommend this. Over the years, I've learned that the final audit is actually a bit of a nightmare. So let's just do some key observations, because I'm moving very quickly about this entire thing. Basically, what you're going to hear from me is that if you're running a small shop, especially if you're a small or medium-sized organization, you might be used to running your own books, doing your own books on an Excel sheet or whatever. And as you get larger and you get into the auditing, the potential to be audited, I think that a bookkeeper, usually don't think of them as an expense. Think of that every dollar you spend on your bookkeeper is probably going to actually save you a lot of money, because the audit trail, remember, it's not just about the time that goes into the audit, it's about the money that they want to get back. And I actually had one auditing firm come in and proudly state at the beginning, we always make our client their money back. Now think about that. Who's the client? The client is the funder. And what they're saying is, if it costs us $25,000 to sit here for 3 weeks at $80 an hour to audit you, we will find $25,000 in mistakes. Now it was a terrible thing to say to me, because it's terrifying. The person was there for 3 weeks and they expect to find as many mistakes as it's costing them. It's a very bad attitude on their part, but it's real, right? It's out there. So my theory on this is get some help, particularly from your CPA, your Chartered Professional Accountant, to help you set your books up, do things properly at the beginning. You're going to hear a lot from me about not being penny wise, pound foolish. The other one that you're going to hear from me a lot is this idea of preparing for an audit as if it's going to happen. So for those of you who are in this, watching this, and you've never been audited, think to yourself right now, if they came in a month, they just send you a little notice saying, I'm going to come and audit. How prepared are you? And really have somebody else answer that who's been through an audit, or ask your CPA, are we prepared for an audit? Because when it comes, there are various types of audits. I'll go through that in a minute, and it can be excruciating. I've already talked about welcoming a midterm, not a final audit, to see that you're on the right track. And what you'll hear throughout this presentation is about the paper trail, being able to basically cover your butt with paper, and also, but not allowing the auditor to see more paper than they need to. And there's ways I'll show you that we can do that. And that finally, it's all about having it in writing beforehand, not trying to find writing later on. So if you took an airplane flight and you visited your mom on the way and it cost $100 more, but you forgot to put the note in, it's going to look really bad later on, versus, oh yeah, well that's why I did it. It's better to put the note in while you've got the expense, put it in there that I paid the $100 back. It's all clean and clear that you were keeping track as you went. This is a really important thing to do. Any bookkeeper will tell you that, but for those of you that are trying to run your own shop and so on, definitely take that one into account. It's about writing it down beforehand so that when the auditor looks in the file, they find the reason, not having to hear from you later on what the reason was. So let's look at whose rules do you follow, because this gets really, we get lots of questions on this about auditing. There's internal auditing, that's you and your bookkeeper. And for those of you who've got opinionated bookkeepers, it's great to have a very detail-oriented, restrictive bookkeeper who holds you to account, makes you sign things, will not give you money out of the books or sign the check until you give them all the receipts. That's an ideal bookkeeper. You sometimes get bookkeepers on, I've had lots of bookkeepers over the years that are pretty sure they know the rules. And the bottom line is your bookkeeper's opinion doesn't matter. In an audit, it won't be your bookkeeper. It's not even going to be your CPA. Because I've had CPAs that I've hired to do the annual accounting arguing that the way we did it was correct. The funder arguing the way that it isn't correct. The funder is the rules that you're going to have to follow. And this is where it gets interesting, because the funder's rules, there's more than one rule book, and you need to be aware of that. So a funder, let's take Global Affairs Canada as an example, may set up a fund called the Small and Medium-Sized Organizations Fund. Let's just use that as an example. And maybe they develop a handbook for it. There was one called the Environment Sustainable Development Program. They had a handbook on it. They told you how you could spend the money, what the rules were. But then they have the general terms and conditions, which is in the contract. So there's 2 sets of rules already. You need to figure out which rules are you following. And my advice on this is that the contract is your sort of Bible of rules. And the contract often will reference other rules, like, for example, Treasury Board guidelines on travel and directives. That's where you also have to keep in mind that those rule books can change, and you need to follow the most recent version. Or you need to document the change that you were following at the time. So if you followed, for example, a travel directory on per diems for Nigeria, and the published rates 3 years ago were this, and now the published rates are that, you need to actually write down, this is where we got it from. I often print those directives out as we're making the expenses, and then tag them to the expense line or to a report. more on that later. The other one, the main one that probably a lot of you are thinking about is Global Affairs Canada, formerly CETA, what their general terms and conditions are. They're very thick. I actually pulled it out and I realized they're in the other room. But it's usually quite a thick set of terms and conditions, and they're standard. They're very scary when you first read a contract from GAC, because it seems like, wow, you're really this detailed oriented, and they are. And what's going to happen is the auditor will come in, look at the general terms and conditions, look at the contract, whether there were any changes to it that were negotiated at the beginning of your contract, and then follow that as a set of rules. We'll also just say that there's a difference between a financial and an organizational audit, just so we get our terminology right. If CETA or an organization comes to do a financial audit, they're essentially looking at your books and the rules around financial policies. An organizational audit, they will come and also look, and they're entitled to do this, is to come and look at your governance structures. Do you hold minutes? What are the security protocols for information? They can look at a whole slew of things, and I'm going to go through an example of that in a minute. And hopefully, sometimes they do organizational audits after they've been working with you for a little while, and they're going to step up how much they want to fund you. And so they want to understand whether the essential elements are in place for good management. That goes beyond just finances, and you should be aware of that. Finally, I'll just say on CRA rules, that's a whole different ballgame. That's tax law. That's to see whether or not you've been doing your charitable status properly, whether you've been following the 10% advocacy rules. That's a whole other set of rules. And they're usually looking at tax and whether or not you're following those rules. That's a different ballgame. I'm not really going to talk about that. I'm going to be talking more about a funder's set of rules. Finally, at the bottom there, you'll see professional association rules, or an example of this might be Van City. If you're doing, or not Van City, or any credit union or bank these days has their own set of rules around the transfer of funds. So if you're working in Africa and you're trying to send $10,000 or $50,000 to Nigeria, you may find yourself having to follow their rules as well. So there's quite a few different rules when it comes to money and accountability. Maybe I'll just say one other thing too, because it comes up a lot, and people say, well, when I have to provide an audit, proof of an audit, what are the different kinds? And there's basically 3 levels of an audit. You can have what's called a compilation, a review, or a full, audit. And so when you go to a chartered accountant company, they might say, well, what do you need? And you'll say, well, I need audited books. Well, that's going to cost you between $3,000 and $10,000, or maybe even more if you're a large organization. And they will actually have to go in and test your systems, see whether the receipts are actually there. They usually have to do a physical visit. They're required to follow a whole bunch of their internal rules about what constitutes a full audit. And you should be aware those rules changed in around 2005 or 6, somewhere in there. About 10 years ago, they changed, and they're incredibly restrictive. It was after Enron. So those auditors, CPAs, who come in and ask you a whole bunch of questions have to be able to show proof that they actually audited you and looked at a whole bunch of criteria. So they'll have to look at a whole bunch of things they're required to look at. So it seems like they're being super anal. It's like, why do you guys want to see that? And you realize that they have to prove that they actually did an audit. So when they provide the financial disclosure and the statement at the beginning, which is the review letter, or not the audit, the audit letter, that's actually proof they did a good job. You can sometimes get away with what's called an audit review. That is simply a statement by the CPA that they've reviewed your books, but they have not gone in and checked into any great detail. Some funders will let you have a review letter, and if you can get a review letter, stick with the review letter. And then a compilation is really just, that's a very, very skeletal analysis of your trial balance. Can everybody hear? Are we good for hearing and everything? We're all good? Okay, keep going. So who actually decides? Now this, again, I just want to point out, because you're going to get into this argument in the office, like, oh, well, whose rules are we following and how do you decide and what's important? And my advice on this is you can be as experienced as it comes, and you've got, like, obviously I've got my opinions about auditing, but to be honest, they don't mean anything. The only person that counts at the end of the day is the customer. In this case, it's the person who gave you the money. So the question is, what are the rules there? And it's really important in the Global Affairs Canada example that your project officer is critical, but only if it was in writing. So your project officer can say, oh, go and spend the money on that. Let's change that budget line item, no problem, because they're super nice, right? And they understand and it's a good idea, blah, blah, blah. It doesn't matter an iota if they said it verbally. You have to have it in writing. So this is important because I've gone through several audits where I said, but the project officer said it was okay. And they go, yeah, but you got no proof that the project officer said it was okay. So in one case, I actually had in the BCCIC audit, I had it written down 3 times by a project officer. The person only gave in and said, okay, I agree, when we actually sent an email to confirm with the project officer that they actually sent that email. I mean, it was incredible, right? 3 times. So take that written business really seriously, that your project officer, it's really important that if they change something, that it will hold up later on, but you have to have it in writing. We'll say also that, that I think I already mentioned that about the chartered professional accountants having their own set of guidelines that they're following, and that you have to respect that. What have I got here? Oh yes. So this is important. So what happens is, the way this works is, Global Affairs Canada or a funder, they rarely actually do an audit with their own people, because it's not a third-party audit. What's going on is you take the money, you spend it, and then Global Affairs Canada has to determine whether you spent it properly. They will hire a firm, PricewaterhouseCoopers or somebody who does this kind of stuff, and that firm will come to your office, audit you, and create a report. And they'll send that audit report back to the funder, and then the funder looks at the recommendations and gets to decide whether or not you have to make a change or follow a recommendation. So they're only providing an opinion. The person who's coming into your office and auditing, they can't say yay or nay or agree to a change. That's not their job. Their job is only to provide an opinion on what's going on materially with the money. Then they're going to give it to Global Affairs Canada, and Global Affairs Canada has the right and the opportunity to accept or reject the recommendation, or make you change or not make you change. You can say, look, we disagreed on the purpose of the money, or we disagreed on this, and you can both write in the disagreement in the report. And then Global Affairs Canada can say, well, we're going to side with you because you did have a conversation with the project officer and we're good with it. And I've seen that happen numerous times, where your difference of opinion is $10,000 or $20,000. Global Affairs Canada says, no, but we're cool. We agree with you on how you spent the money. So you don't have to think that the auditor's report is going to land you in trouble. The auditor's report is just an opinion on what happened to the money. Got to keep going fast here. Where are we at for time? So I got a lot to cover here. Yeah, I better keep moving a bit faster. So a couple things. The key is to prepare. So one of the really critical things is, and this one is a hard learned lesson, by the way, is when they first sign the contract, take advantage of that stage by going through the general terms and conditions and then getting it in writing exactly what you're going to do. So for example, get your timesheets approved, or your methodology of timesheets approved. A classic, we're going to find out later on that timesheeting and wages are probably the biggest way that you can get screwed in an audit, because somebody doesn't like the way that you timesheet, or they don't agree that you're allowed to do overtime in lieu. And I'm going to use that as an example. In BCCIC, I made sure in the last audit that in writing, it was written down in the auditor's report, that I had a note from the project officer that we all agreed that BCCIC is allowed to do overtime in lieu, meaning that we can log overtime, or let's say I don't work a 37.5-hour work week, I work a 50-hour work week. Theoretically, in the general terms and conditions, I'm not allowed to do that. So they would just disallow all that overtime. But we have it written down that if I take that overtime, I can take time in lieu later within 60 days, and we laid it all out very clearly. If you don't do that, later on, the auditor goes, well, yeah, you had the conversation, but there's no proof. So again, you do the proof business before you do the expenditure. Really important that you take, and I would recommend that you do this, is that you take your expense sheet, go, is this going to be satisfactory? Get your project officer to write down, yes, we agree with your travel rates, your overtime policy, your expense sheets, and your time sheets. I can show you an example of this in a few minutes. The other one is that if they are going to do an auditor's visit, welcome that. You do not want to hide anything at that stage. At the very beginning, you know how audits are, you kind of are a little bit shy to show everybody your books and so on, exactly how you do things. And that very beginning of the contract is the ideal time to be completely open. Like the auditor, when they came for the BCCIC books, showed them all the accounts, showed them everything. Is that satisfactory? Get them to nod their heads, and then get them to write it down. So I'll show you details of where they actually wrote down, we agree with how you're doing things. That's going to cover your butt later, because what happens is their people change. They might not even use the same firm when they come to do an audit, and that's important too. They can switch firms. And also your project officers change, like sometimes they change a lot. So you want to keep that in mind, that you're talking to a project officer today, but 3 years from now the project officer is different. So definitely send a synopsis of conversations that you had with your project officer regarding financial information. and then log it and put it in your audit binder. I'm going to talk about that in a few minutes as well. Am I going too fast, or are we okay? Good. I've already talked about that worst case scenario. How do these auditors think? I'm just going to go through a little bit about this, because an auditor's job is really to sleuth, to try to look for nasty, nefarious activity, and they're really interested in anything like that, and they know a lot of tricks about double dipping. They know a lot of travel tricks. There's tons of tricks out there, and what you ideally want to do is be running a perfectly honest shop, and then what will happen is they'll figure that out pretty quick, and then you're off to the races. If you've got a skeleton in your closet, you did something, you know, there's some money there that you shouldn't, you know, maybe you took somebody out for lunch and it really wasn't an expense, whatever. You fix those before they come. Just note, what are my skeletons in my closet? Go fix them right now before the audit happens and clean them up. And then if you're running a clean shop, you don't have to worry about an audit being a nightmare. But trust me, these guys are pretty good. They've seen all the tricks in the book usually, and they'll go through and they can figure out those tricks really quickly. I should also say that just philosophically, it doesn't help if you're defensive. Like, it actually helps a lot in an audit if you're just completely open, right? But to be able to be completely open, you actually have to run a transparent and a good program. So just check yourself on now and internally and go, like, how open do I feel? How defensive do I feel about my books? Are there things in there that I need to clean up? Go clean them up. Also, I'll just say that don't make it too fun. And one of the lessons I learned about auditing is, you know, the first time an auditor came in, I made a super big mistake. I made them really comfortable. They loved being in the office. They enjoyed all the camaraderie and the talk, and they just hung out and they hung out and they hung out and hung out, and they were there for a long time. Then they came back again and they came back again, and I realized when it was all over and done that they had just built a lot of time and they'd enjoyed it. Now when they come, I put them in a very small room. I don't let them talk to anybody. I give them only the information that they need. Keep it professional, keep it courteous, but don't make it like it's an enjoyable place to hang around. Otherwise, like, think about their lives, right? They're sitting in an office in some auditing firm in a cubicle. It's really fun to be in your office. Next thing, they're trying to find excuses to stay there and keep auditing and keep auditing. Finally, don't get antagonistic, because you're going to find that they get anal. It's their job to be anal. It's their job to look for those details. And if it gets frustrating, like I said, or I haven't said yet, but go find some way that you can blow off steam, because an audit is definitely a frustrating process. Any of you who've been through that know what I'm talking about. If you haven't been through an audit, trust me, it is frustrating. So will you be audited? You could go for a long time and never get audited. There's generally, most funds run by the federal government have got sort of a degree or a percentage of numbers of project within a fund that they have to prove have been audited. So they might have to say, look, out of $100 million, we need to audit at least $50 million worth of projects, and you're randomly going to get picked out of that. So there's periodic auditing that also happens, that after you've been working with an organization for a certain number of years or a period of time, they will want to have audited you. So if you're hoping to work with Global Affairs Canada over a period of 5, 10, 15 years, definitely you're going to get audited. There's also just this idea of midterm and final auditing. I think I've talked about that. You should expect that if your project is over the $2 million threshold, it automatically triggers an audit. That's what I'm told. Again, this is all just stuff that I'm told, so opinion. If you're in that $2 million contribution agreement threshold and larger, you should probably expect a midterm and a final audit. The final audit, again, if you're the final audit. Also, there's a thing called the Financial Risk Assessment Unit, FRAU, and what they're going to do is they're going to send you a questionnaire. I'll show you an example of one of those questionnaires in a minute. And that Financial Risk Assessment Unit, if you score low on that, or that you're a high risk, then you should expect an audit. So the higher a risk you are, the more likely that it will trigger an audit. So if you're a small and medium-sized organization, you're handling a lot of money, it's very likely you will be audited. And what I would do is assume that you're going to get audited. Also, I'll just say contribution agreements tend to trigger audits, I've found, more often than grants, because a contribution agreement has sets of rules around contributions and so on, and they tend to be for larger amounts of money. If you've got a contribution agreement, you're probably going to get audited eventually. Also, just to say that an audit can trigger more audits, and what happens there, particularly, it's just like forensic auditing. Like if they go in and they find, oh, they took every 7th receipt and they checked it, and the first receipt they find it's not done properly, what that does is it triggers a deeper audit. And then if they come to the second one, you know, they go look for another one of those travel ones, and it's still not there. That's going to trigger an even deeper audit, to the point that they can do, and Global Affairs Canada is mandated or able to do a 100% audit. So when they came to do our audit of BCCIC, it was considered a 100% audit. They're going to go through 100% of our receipts. In the end, they didn't. They went through He told me 62% of our receipts. And by the way, maybe it's part of the boasting thing, I guess, but maybe just to give you an idea of how anal we have become, or I have become about this, is that was the first audit that auditor had ever gone through in which he found 100% of the receipts and 100% of everything was correct, with the exception of one issue around GST and travel and the assignments of GST. And that wasn't really a mistake. It was a difference of opinion. So he said that's the first time in his entire auditing experience that he'd gone through an organization and it had been completely clean. And that's only because I went through those previous 19 audits and they were not clean. So you get to realize exactly what you need to do. And I will say finally that if you think that political auditing doesn't happen, don't be naive. If your organization is doing anything political, is doing anything that puts needles in the side of the federal government, they may claim that you're just randomly being audited, but I've had several people contacted me within government in the past saying, we noticed that you're getting ridiculously audited. And it was because of, we finally had the sort of showdown in the office with Global Affairs Canada senior auditing. You say, what's going on here? And she said, well, we'll be honest, we know that you're politically aligned with this and politically aligned with that. And so we're auditing the heck out of you so that we can cover our butts. So keep that in mind, that, like the more loud spoken you are, in the environmental groups have certainly been hit really hard with Harper audits. Hopefully that stuff is going to slow down with the Trudeau government, but we don't know. So point being, politically you could get audited. So let's go and take a look at what is a financial risk assessment. Can we see share screen? Where are you seeing my? No, I have to. Okay, wait a second. I have to stop share. I have to go share screen, and I go to financial risk assessment. That's this one here, I think. Here we are. Can you see that? No? There we go. Good. Okay, so what a financial risk assessment is. This is a good thing to do. See if you get a hold of this. If you don't have one of these, then let me know, and I'll actually send you a copy of this. This is something that they'll do prior to doing an audit, and it's just to check your accounting systems, and they'll score you on this, and then they'll give you an overall score, and then the score determines whether or not you're going to get a deeper audit or what kind of an audit's going to happen. And the kinds of things they'll ask, like you can see here, please describe the type of accounting systems. Is it electronic? How do you, let's go down a little bit deeper. How are salaries approved? What payroll system do you use? Is it external payroll, for example? Or in relation to consulting fees, do you establish a contract with all consultants and subcontract? They're looking for essentially management protocols. How do you do your books? And they're going to study that. When the auditor first comes, they'll study the contract, they'll study the proposal, and then they'll ask you a series of these kinds of questions. And they'll have to do with liquidity ratios, debt ratios, understanding your organization's vulnerability. Essentially what they're doing is, think of it this way. They give you a pile of money, and then what they want to figure out is, if you screw that up, can we get our pile of money back? So in other words, if you, right now, if you liquefied if we just shut our shop down here at BCCIC, and how much money would be left in the bank that's unrestricted, that they could sue us and get their money back? So let's say you've got really diversified funding and you got 35 different funders. They know that there's enough other cash around that they might be able to get some of that cash. But if the only funder you have is Global Affairs Canada, and you screwed up with their money, then you could shut shop tomorrow, take off with $100,000, you spent it on a Ferrari, and they're super vulnerable. So they're going to be searching for liquidity, debt ratios, all of these sort of financial risk items, and your chartered professional accountant can clue you into those things very quickly, looking at how you handle your deferred revenue and so on. I won't go into too much more detail on that, other than to say, go through the financial risk assessment if you haven't got one, or you can ask your funder, what are the criteria? I know Global Affairs Canada uses about 7 different criteria to establish your risk, your riskiness, and then they score you on that riskiness. And then if you score low, then they put in place mechanisms to compensate for that risk. They're not supposed to disallow your proposal or not work with you because you're risky. They're not supposed to, right? Now they may privately do that, but in theory, they're not supposed to. Other funders, it's totally up to the other funder what kind of mechanisms they'll put in place. Like, for example, they might go, you're kind of risky, so we're going to make you report quarterly instead of semi-annually, and we're going to reduce the advances that we give you. So instead of sending you 100, we're only going to send you 25. or we're only going to send it to you every 3 months. Make sure you report on it properly. Those are the kinds of things you'll see an audit in the audit recommendations after they look at your systems. I won't go into too much more detail on systems. And how do we get back to? How do I get back to?
Gotta stop your screen.
Oh, I gotta stop screen sharing. There we go. And then screen share. Go back to my PowerPoint. There we go. Good. Okay. So what are they looking for? A couple things. If you're a small mom and pop operation and you're doing cash accounting, stop that right now. Go and get an accrual system with deferred revenue and expenses. If you don't know what the difference is, ask your CPA or your bookkeeper. They will know. And the idea there is, remember, turn your microphone off. Remember, the idea there is that you're actually looking, with cash accounting, it's kind of like how you do with your wallet, right? You put a bunch of money in your wallet, you go, you spend it, then you go get some more cash and put it in, and you basically just see how much money there is in your wallet at any given time. That's not very good bookkeeping. What good bookkeeping is that you might owe somebody a bunch of money, or they owe you a bunch of money. And so you account for all that money that's owed or owing, liabilities and revenues, and somehow you can show what your picture is. So the money in your wallet doesn't matter, it's how much money you actually have in life. Okay, that's what accrual accounting is. They're also going to look for levels of accountability, really going to look at things like double signatures. Ultimately, does your board of directors control or oversee things? And what happens there is many organizations, especially if you're small and you have an ED that's running everything, maybe the ED can sign checks to themselves. That's going to be a bad, so ask yourself right now, if you're an ED, could I theoretically write a check to myself in this organization and just walk away? Or does it require a second signature over a certain amount of money? Like a good protocol might be that, you know, up to $1,000 you can write checks to yourself. After that, it requires 2 signatures. At least one needs to be a board of directors. That would be a good policy. So do you have that? You can ask yourself that right now. If you have, that's great. That's good. Those are the kind of protocols they're going to look at. I also said this business about liquidity. Stop all your operations right now because somehow something went wrong. How much money, if you sold off all of your stuff, would you have left to be able to pay the funder back? That's what they're going to ask. Debt ratio, what they're looking at there too is, let's say they give you $100,000, but you owe, like you have liabilities of $200,000 sitting on the book because you screwed up in the past. Theoretically, you know, if worst came to worst, they'd give you $100,000 and you'd go pay off those other people because you have high debt ratio and never do the work. And then quit, and they're screwed. So they're going to look at debt ratio as well. And they're also going to look at diversity ratios, how much money is coming from a single funder. And also they're going to look at, do you have written policies, like an HR manual, expense sheets, travel expense sheets. That's one of the first things the auditor does. They sit down, read through the proposal, and look at all of your policies. And then do you have the actual practices in place? And that's where I would, again, I would try to restrict your accountant's ability to snoop. So they come in and they tell you they're just looking at the books. They're not. Don't kid yourself. They're coming in and they're looking around. They're listening to everything that's going on. They're checking if they can get access to your general ledger. They will, so that they can look around and see where the money is all going. It's their sleuthing. That's their job. So you can reduce their ability to sleuth. Common mistakes. This is kind of the meat of the thing. So I'm going to keep moving quickly and jump in with questions if you have them. Contract start dates is a classic. So you've been sitting there working on a project. You've got an office in Uganda, you haven't got the money yet, Global Affairs Canada agrees you can do it, you have a bunch of expenses, but you didn't sign the contract. And what the auditors do is they come in and they are going to look at all of the expenses at the beginning of the contract, and they're going to be looking for big ones. So let's say you had a $5,000 expense the day after your contract was signed, they're going to look at that for sure, guarantee it. And the reason is they're going to see if you just owed money before the contract for work that took place before the contract. It's classic, absolutely classic. So if that skeleton is in your closet, go fix it right now. Disallowed expenses is probably the most common way to rack up a lot of money owed back to the funder. And you have to read the fine print on what's disallowed or what's considered overhead. So let's say Global Affairs traditionally gives you 12% money to spend on overhead. They will then describe the overhead expenses. So for example, your telephone, your rent, your office expenses, all these things that really cost you a lot of money, those are disallowed. You can't spend those on the project. Those are supposed to come out of overhead. So, and they're never going to look at your overhead expenses. It's none of their business to look at overhead expenses. That's your running of your shop. What they're looking at is the direct expenses generally. And if they find indirect expenses, oh, you put in a telephone bill in there, they're going to disallow it, and it adds up. So classic ones there, especially around rent, are if you rent an entire office and then you run an internship program, and one corner of your office is dedicated to interns, but you didn't get written permission from your project officer that that percentage of your rent is going as a direct project expense. If you didn't do it, the auditor comes in and goes, no, sorry, rent's disallowed. And so they're going to knock it out. And those can add up, because if it's a monthly rent over 3 years and you thought you were able to pay for it, but you didn't get permission, you're screwed. By the way, on those, on that one in particular, that is a very good one to know, that if you do get permission, because let's say you get a project, you've got an office, there's 5 people working in the office, and you're going to take on a project. Internship program's classic. And you're going to have 2 intern people sitting there in the corner. Well, you can actually say that that's if you negotiate, you can say that's an expense that's directly attributable to that project only, not our general operating expenses, and you can prove it. So then you can get it, or especially if you rent another office or something. So keep that in mind, that if you negotiated it, your project officer said it was okay, and it is not a disallowed expense, it's an allowed expense. Get it written down, put it in the contract, put it in the book, your binder, your audit binder, and keep it there. Timesheets and payroll is so important. I'm going to go over it in detail. Same thing with double dipping, travel expenses, super classic mistakes made there. A lot of classic mistakes around not documenting in-kind and volunteers, or not documenting them in a way that they will be satisfied with. I'll also go through that in a bit. Procurement rules, exchange rates, super complicated. And then finally, this last one, I'm not going to go into great detail, but you obviously are not allowed to make a profit. And this can be confusing for people, because here's an example. They give you $100,000 and you had in your budget, you're going to do a workshop for $10,000, okay? Then you go to do the workshop and somebody volunteers to give you the venue. Another person says, I'll give you the, I'll give you a subsidy or something, you know, and you manage to get it so you can pull off the $10,000 workshop for $2,000. So you think, well, great, I'll take the 8 and I'll put it in my pocket, save it for a rainy day. That you're not allowed to do. That's making a profit, right? You will be expected, if you didn't spend $10,000, to reallocate the $8,000 to something else in the project. So this is a common classic mistake for people, because let's say you're in the private sector. If I promise you something for $10,000 and I can deliver it for 2, then I save $8,000 and I can do whatever I want with it, because you got your deal. You offered to spend money for 10. It doesn't work that way in our business. In our business, if you didn't expend it, then you're not allowed to claim it. I hope people understand that. And if you didn't understand that, ask in the questions, because that's a common mistake for people that are coming from the private sector, working in the nonprofit sector and doing contribution agreements. If you can't receipt it, then you can't claim it. Just quickly on start dates, it's the date of the last signature, not the date they signed it. That's a really critical one. So when you get your contract, sign it immediately, even backdate it to the date that they signed it if you're clever, so that you can make sure that all of your dates are going to line up. Again, I've said they're looking for large expenses at the beginning of the contract. Oh yeah, so yeah, this is a big one. So let's say somebody invoices you for $5,000. The first thing the auditor is going to ask themselves is, well, it was signed a week. You paid for it a week after you started the contract, and the person billed for $5,000 worth of hours. How'd you do it in 1 week? You can't do it, right? So be careful about that. That beginning date thing is really important. If you're gonna have really large invoices or something, then make sure you're paying them a month or 2 months later. Also, date of the completion. Note that many contracts specify that, let's say the project goes to March the 19th for activities, okay? But you're allowed to report until maybe June, okay? So that gives you an extra 3-4 months. The problem is this is classic on large contribution agreements for overseas development projects, is that you go over there, you do a project, you're allowed 6 months of reporting. You have to differentiate between project activities and reporting activities. And I would spend some time and effort coming to the end of your project, working with your project officer to clarify exactly what you plan to spend last remaining period, because you cannot suddenly do another workshop after the March end is done, because you didn't spend all your money in the project, so you want to get it all spent. You can't spend it in the reporting period. I've had that one pop up several times where, you know, we think we're doing a good job and we're spending all the rest of the money, but you didn't spend it by the activity's completion date. So keep an eye on that one for start and end dates. Double dipping, this is the one where people really the auditors are good at finding these. And sometimes they're just mistakes. Like they're legitimate mistakes. Don't fret about it. You got caught. It particularly happens on a split transaction where you have, let's take an airplane expense. You fly to Uganda, but two funders pay for it because one funder wanted you to be at this meeting and the other funder wanted you to be at that meeting. How did you split the transaction? Can come up and it can be an argument between you and the auditor. So here, let me give you an example. You fly to Ottawa for a meeting. You have 3 meetings lined up. 2 funders pay for it for the airplane ticket. What percentage do you split if you only meet for 1 day with one and 2 days for the other? Like, how are you going to do that? You could argue all day about this. So the trick is to write down how you split the transaction and why you split it that way at the time that it took place, not later on when you're talking to the auditor. This tends to work, by the way. If an auditor finds a piece of paper with an explanation on it that was written at the time, I've rarely had them argue. But where they'll argue is later on when you're sitting there going, well, at the time, it was a meeting for this, and they don't like that. So just write stuff down as you're doing it, and don't expect that you're going to be able to remember it all later on when the audit comes. It's better just to keep writing stuff down as you do it. So travel expenses received but not taken is a classic one that they clued into quite a few years ago. People would book tickets, they would pay for the ticket, and then they'd cash the ticket in because the meeting changed. But on record, it looks like all the receipts are there. So they will ask for boarding passes and proof of travel. This can become a real problem if people don't keep boarding passes or if they don't keep proof. And it is legal if you have a picture, a photograph, and you can prove that, okay, Sally, she went to Nigeria and she attended this meeting, and here's a picture of her in the field. And you can prove it that way. You can use other forms of proof of travel, but the preferred method is an actual boarding pass. So people are getting into electronic boarding passes these days. I'm still a paper person on that because of this reason. So ask your people to print out their boarding passes and keep them. Timesheet double dipping we're going to go into in a minute. That's a whole subject in and of itself. So let's go to timesheets. I'm going to pull up, how are we doing for time? Speaking of time? About 50:10. Wow, I'm going slow. Sorry about this, you guys. There's a lot to cover. What am I going to do here? I won't get through all this.
Oh, we have an hour and a half.
We have an hour and a half. Oh, great. Okay, then we're fine. You can listen to me drone on some more. Shall we just do a quick check and see if people put up your hand if you're still finding this interesting or you want more detail, less detail? Am I going too fast? Just any comments on that. If it's all working for you, just put up your hand.
There's no hand.
There's no hand? No. Oh, how do we get a check?
You can chat, put in the chat box. Just say
okay, just give us a bit of chat. Just write in there and make sure that this is still interesting. Otherwise, I can modify. You know me. I've done enough of these websites that I'm happy to go into more detail.
Still very interesting.
Still very interesting?
Good.
Okay, you're doing great. People are happy. Awesome. Okay, good. If there's anything you want changed, just let me know. I'll change. I go into more detail. I can rant more, whatever you like. But let's keep going with timesheets because this is probably the classic one that I've seen the biggest mistakes on. So you say you got a $100,000 project. Let's face it, probably 60% of that's going to be wages, right, or more. And so, especially with the bigger projects and you're hiring a lot of staff. And here's what happens. You thought you were timesheeting properly. You weren't. And they come along and they disallow timesheets. It does not take long for that to add up. Like, let's just take an overtime problem. An overtime problem not properly timesheeted, not dealt with properly. You've already done it. You've already paid. There's no getting the money back. You're screwed. So timesheets, I have learned over the years, is your #1 thing to get right. Put that one on your notes. #1 thing, timesheets. And make sure, so let's go through them. The smartest thing you could do would be to get your timesheets or get a good form of a timesheet. I'm happy to share our timesheets. I know they work, and I know they've been approved, and I know they've survived audits. So if you want to use ours as templates, go ahead. Just modify it for your organization. And then what I would do is at the beginning of your project, send your timesheet to your project officers and say, could you please, in writing, acknowledge that this timesheet is sufficient, okay? And now you're safe. So there's a couple things that I'm going to go through. Let's just look at a timesheet, okay? Let's pull up shared screens again. How do I do? Yeah. Let's pull up a timesheet. I'm going to use mine as an example to show you a couple of the principles of timesheets. First of all, this timesheet you'll see over here, has employee, the title, and then it's signed off at the bottom. Oh, am I sharing? Yeah. You got that? It's up there? Okay, good. Somewhere down here, employee signature, and then BCCIC authorized signature of the direct supervisor. So you'll notice if I sign off, it doesn't mean anything. My timesheets need to be signed off by a board of directors and dated. And now you know that somebody because you can never sign your own timesheets. That would, and this is a general principle in accounting, by the way. They're going to look for every time there's a signature, was there a level of accountability higher than that was overseeing it? And the ultimate level of accountability is always the board of directors. So if you're an ED and you've been, signing off on things and nobody's ever looked at what you sign, probably the auditor is going to catch you on that, and they're going to deeply question it. So, there are levels of consequentiality on this. Like if you're signing a $10 check, who cares? Or even up to $1,000, it's pretty standard that you can sign things up to $1,000. After that, really somebody should be looking at your ED signature to make sure that you're accountable to a higher authority, ultimately the board of directors. So on this one, you'll note that down the side, the dates change every month, so you just change the dates. Along the side here, you'll see that its columns have to do with the funder, and depending on what kind of electronic books you're keeping, like in QuickBooks Nonprofit Edition, they use what are called classes, and a class is essentially the type of money that you have or the type of time that you have. You'll see in this one I'm only using 2 classes or 2 funders because as the ED, only 2 people. Well, actually, this isn't mine anymore. This is an original one from 2014, so mine's changed. But basically, at the time, only 2 people would have been funding a position, DFAT-D, which is Global Affairs Canada, and IDRC. And in theory, you could add a foundation. The Sustainability Foundation is another one of your funders. The local bank is another one of your funders. You can list them in columns so that you can assign your hours. Now, you're going to think that's super anal, but the reason is that DFAT-D or Global Affairs Canada or a funder may have agreed in the proposal that they're paying for half of your time. They're going to hold you accountable to that later on. So for example, DFAT-D will only pay for 90% of my time. So I have to have up here in the corner, up here, you'll see that I have the number of eligible hours this month. That's the number of hours that I'm legally allowed to work, which is 37.5 or 7. In this case, you'll see up here in the bar at 7.5 hours times 23 days, because that's how many days there are in that month, and days vary between 20 and 23. So you work out the number of eligible hours, and then you can work out the number of eligible hours that funder will allow you to fund, and then you track it, and you track your overtime. And then what we have is an overtime policy in place that after every 60 days we have to reconcile overtime. So that what they're going to do is this gets complicated. Can I go to the board now? I want to go to this board. Can I do that behind me?
Yeah, just stop sharing.
Just stop sharing. Okay, and I see my.
Yeah, it just shows you.
Well, there I am. Oh, beautiful. Okay. Well, not beautiful, but you know what I mean. It's good that I can see you now. Let's take this. Okay, here's the basic formula. What they're going to do is they're going to come in. They're going to figure out what's called a daily rate. Now, this is going to vary. If you have a grant, they might not do this, but in a contribution agreement, the accountant will come in. They're going to say, okay, so Mike, you're worth whatever. Let's just say we were auditing a person who's worth $50,000 a year. They're going to say, okay, $50,000, okay? And then they're going to add all the mercs and all the amounts of money that you're totally worth. Okay, and let's say that that's around $56,000 just for fun, okay? And then they're going to say, okay, well, let's divide that by the number of eligible work years in the year, and that's 260. And this is what you need to pay attention to, because the average is 260. So what it means is there's 365 days a year, only 260 of them are working business days with stat holidays and so on and so on. You want to check that, because in some of your organizations, maybe you take a Christmas break, for example. Well, then it's not 260. It's going to be 260 minus the 2 weeks. It'll only be 250. Now, the reason that's important is they're going to divide that by that, and they're going to come up with an amount of money that you're worth every day. How much is that? Let's just do that for fun. 56, 1, 2, 3. Divided by 200, let's say 250, you're worth $224 a day, okay, or X number of dollars an hour. Then they're going to go to your timesheets, and then they're going to take the number of hours that you logged in your timesheets times your daily rate or your hourly rate. They're going to add that all up, and then they're going to compare that number to how much money you charged them when you charged payroll. And I guarantee half the time there's going to be a difference. And that may or may not be in your favor. So but do your math right now and figure out if it actually worked. If you're in a project, if you're about to go into a project, know the formula. Because I've seen this mistake numerous times with various different organizations. So the trick is to have more hours in your timesheet than what you charged them. Everybody hear that? This is incredibly important. You need to have more hours in your timesheet than what you charged them, so that when they realize, oh, you charged us for, you charged 90% of 56, let's just do that for fun. What is 56,123 times 0.9 is equal to, I could have theoretically charged them $50,040, okay? So let's say you made the mistake of attributing, you know, all of Mike's salary. This isn't my salary, by the way, but let's say you actually attributed the entire thing to them and you charged $56,000. You thought everything was square. Well, they said, no, the most we have to pay you is $50,040. If we use the 260 formula instead of the 250, you'll see they're going to have to pay you even less, right? So figure that formula out. They'll explain this to you when they first come, but if you don't understand it, you're going to get screwed on timesheets. So timesheets, and people, I've seen people like $200,000 into a mistake on a timesheet issue, and there's no getting out of it. The other one is if your timesheets aren't signed, make sure you sign those darn timesheets. Let's keep going here because I'm going to run out of time. So understand the daily rate calculation. Make sure you calculated the number of days in a work year, according to your organization, and then make sure that's backed up with a policy. And then write it down, send it to your project officer and say, can we please confirm this is the number of working days that our organization has in a year? Classify your timesheet if a position has multiple funders. If you're only funded by one funder, you don't need to worry about this. But let's say you've got a person who works half-time on a global affairs project, a quarter time on a sustainable foundation project, and a quarter time on a Canada Summer Works program. You're going to have to differentiate those funders, keep track of the time, and prove to Global Affairs Canada that you never worked more than a 7.5-hour day or a 37.5-hour work week. For those of you that are doing overseas projects, be very careful about this Global Affairs Canada rule in the general terms and conditions that you can only work 5 days per week while in Canada and 6 days per week while overseas. I've also been caught on that one, and it's the stupidest rule. If you're going to change it, figure out how to change it, like figure out how to work this, because what happens is you go off to Uganda for a month. While you're there, you work every day because it's only a month, right? That makes total sense. That's what everybody does. Let's say you go for 2 weeks, you work the entire 14 days. You're not allowed to do that. You're only allowed to log 6 every 7th day. You have to take off according to the rules. So now you went and timesheeted all that, you charged for it, and they disallow it later on. You now owe 4 times in a month project. That's 4 days, and it adds up. Trust me on this, it adds up over a project. Keep going.
I've got a question.
Yeah, question?
How do you deal with vacation in timesheets?
Oh, let's go back to that timesheet. That's a great question. So what you do is, let me just go back and, are we there?
No.
Sharing? No, stop share. And then start share again. And there's a vacation column. You see it? It's coming. There we go. Okay, right here you'll see vacation. So what you have is a policy on vacation, and what they're going to do, this other one, by the way, is they're going to go through all of your employee contracts. And let's say you don't have any contracts with any of your employees. That is really bad. So you, again, skeletons in your closet, ways you can prepare for an audit is go and get contracts with each employee that are up to date, that state the number of days of vacation that they are allowed, because that's paid vacation time. Let's say you have an employee and they get 3 weeks vacation a year, but you get 4 because you're the boss, right? So if that's not written down, they're going to go back and say, well, you're taking too much vacation and we're disallowing it, etc. So you have a vacation column, you have a sick days policy column, and you have a statutory holidays policy column, keeping in mind that statutory holidays are different in each province. You also should have a policy stating whether the organization is following federal or provincial statutory holidays or not. Isn't it crazy that I even know this stuff? I mean, it's sad that I'm the agent of an organization and I know stuff like that, but it's because you get audited and they go, well, which holidays are you following? And if you didn't have it written down beforehand, you can't start making it up afterwards. This is the trick. If you're not getting it yet, is if you write it down beforehand, you're safe because you wrote it down and you say to the auditor, well, we got a policy. And you pull your policy out and you show them, you see, and you go, well, look, we follow federal and provincial holidays. And so you're allowed to put the stat holidays down. And what that will do is it will determine, coming back, you can't see me anymore, but I'm pointing at that whiteboard again that says, is it 260 days? Is it 258? What number of days is it? that's one of the first things that your auditor is going to come in and try to figure out is what are the rules around the number of days and the number of sick days and so on. I hope that answers your question. So this, by having these other columns, you just track the vacation day, you track what is a vacation, what is a stat holiday, and what is a sick day. And you're allowed a certain number per year. And then that should add up to an eligible expense. And by the way, without this timesheet, let's say you don't have timesheets, you're 100% screwed, because theoretically, if you didn't keep the timesheet, you got no proof. And so the other one I'll just say on timesheets too is that let's say you got interns or you got people that you're paying. If you're not using a payroll company, then you have to have a way of proving that the person actually got the money, not just a check. So let's say, because here's the classic, what a person does is they write a check to an employee, the employee cashes the check, takes the money, and either does something else with it, or it's not a way. So you have to have a way of proving proving that they received the money. And so usually that's in a payroll stuff. Like if you're using a payroll company, it's really easy. The payroll company paid it, they sent the check, not you. So there's no way that you got the money back. You following me on this? So, and if you don't use a payroll company, then what you should have is an acknowledgement from the employee that they received the money. I know we're getting to levels of anality here that are unbelievable, but it's happened to me. They've come in and they said, prove to me that the employee cashed the check. And I'm like, are you kidding? Why wouldn't they cash the check? It's like, prove it. I'm like, well, how do I prove it? They go, you should have had a remittance stub that says, that's signed by the intern that said they were paid. I'm like, well, and they just, I mean, that's something that we argued about. They put it in the report. I go back to Global Affairs Canada, auditing department. We have an argument. It's adding up to a lot of money. And they go, no, we believe they were paid. And I get letters from interns stating after the fact, years later, yes, the person did pay me. So that's why I say if you do it beforehand, you're safe, right? Okay, we've got to keep moving here. So where are we? We're back at stop share. And share screen. I want to come back to the PowerPoint, which is where is it? Here we are. PowerPoint. Good. So get your policy acknowledged by Global Affairs Canada if it differs from their policy or their timesheet. By the way, the one that the timesheet that Global Affairs Canada gives you is a pile of garbage and will not work. So don't use the Global Affairs Canada timesheets that they used to put out. I haven't seen the most recent ones, so I won't say that about recent ones if they're better. But I would follow a better format and get it approved by the auditor. Let's keep moving. Disallowed expenses. So the obvious ones are the rent, telephone, the cost of bookkeeping, and anything to do with administration. Sadly, those add up. And I know, and I sympathize with all of you as to how much it actually costs to run an organization. But unfortunately, those are not allowable unless you get it in writing. If you get something in writing, by the way, we have it in writing that 50% of our bookkeeper is paid for by Global Affairs Canada. And I got it in writing. So 50% is paid, they can't argue. The guy came in, he goes, how'd you get this in there? He's the auditor. I said, it's in writing, dude. You can't argue. He goes, yeah, it's true, I can't argue. Otherwise, he wanted to disallow it, right? So get it in writing. Know what a direct project expense is and get it in writing if you're unclear. I've already said that a million times. Say it one more time. Overseas direct project expenses. Fight for this tooth and nail. So what I mean by that is that your overseas expenses, let's say you're running an office in Sierra Leone, and all of the expenses of your overseas project, if you are a Canadian organization, and your local partners' overhead expenses are all direct project expenses. And don't let them tell you any different. If they say that's an administration cost for your local partner, you say, yeah, but we're funding the local partner. So the local partner is not the executing agency. The only agency that has disallowable admin expenses is the executing agency. That's you. So if your partner down south has admin expenses, you're allowed to pay for those. And if you get some young project officer that doesn't know that, fight on this one, because you're allowed to pay for their telephone, you're allowed to pay for their office paper, etc. That's all allowable. Fight for that. It's happened to me before again. 20% subcontracting rule, I put it in here because, boy, they can catch you on this, and it's a big deal. What it is essentially what people started to do is they would get a contract from Global Affairs Canada to go and do something, and they said they were going to do it. And then they write so many proposals that they can't do them all, so they start subcontracting proposals out. Then they start realizing it's actually a pretty good deal because they can get the overhead and so on, and somebody else does all the work. But the people that Global Affairs thought was going to do the work, which is your organization, you're not doing it. Somebody else is doing it. So they put in a clause that the maximum amount that you can subcontract to other groups to do the work you said you were going to do is 20%. And this can be really, really sticky point. I just really warn you on this one. Go through and figure out your project plan. Were you actually going to subcontract it all? If you were going to subcontract it, shift it in your proposal writing stage and list that as a partner. Then they're no longer a subcontractor. Or, again, write to your project officer and ask, would you consider them as part of our organization? This gets really tricky if you're doing consortium approaches or you're doing partnerships with other groups. Be very clear about what is, with your project officer, about what is a subcontractor and what is not. Because the auditor can come in and they're looking for this one. They'll cut it off at 20%. Now you're screwed. There are obvious ones too, or super obvious. Anything, and auditors look for this. They go through and they're always looking for a beer or a wine or a gift or an honorarium. You know, they have classic ones that are disallowed. The ones that you may not have seen are things like immunizations, visas, passport fees. Those are actually disallowed expenses. They're not allowed to pay for those. And those can add up. Let's say you're sending off interns and you're going to send 15 interns and they all need their yellow fever shots and $300 worth of immunizations done before they go. Well, you're looking at a lot of money, and that's not eligible. And the obviously ones are non-authorized family members. Be really, really careful about anything. Like, let's say your sister does something for you. She's super nice. You pay her an honorarium. They're going to look at that. I promise you. They see the same last name. They're going to look at it. So that's really good to cover. Be very, very careful and cover all. Those can be, let's face it, friends, family members, and small organizations. It might be a small operation and you depend on those people. If you do get into stuff where nepotism could be perceived, again, just cover your butt and write it all down exactly what happened. And you'll probably be okay. Let's move to travel. Travel, this one gets people, because again, beyond wages, travel is probably your next biggest expense when you're doing overseas development work. Lowest economy fare is exactly that, and it's as of the day that you bought the ticket or that you did the reservation. This is important too, because they can historically go back and figure out what was the actual cost of the ticket on the reservation day. The best way, there's two ways that we've done it or that we do it. One is you either use Expedia or Kayak or one of those things and print out the page on the search. That's your proof that you got the lowest economy fare at the time. Or we were for a while using the services of a travel agent, and the travel agent wrote an affidavit or a letter claiming that they will always give us the lowest economy fare. So that's proof that we never are trying to, purchase tickets. Because what happens here is what they're looking for is, let's say you've got yourself a nice little carbon criminal card. What do you call those things? For traveling a lot, you get to travel a lot. What is that called?
Oh, like a rewards.
Rewards card. I call it a carbon criminal card because it means you're traveling too much and burning up too much of the world's carbon. But basically, if you have one of those cards, you might continually buy the more expensive ticket because even though WestJet's got a cheaper fare, you're buying Air Canada, and they know that. And so you're not allowed to do that. So you need to purchase the cheapest ticket. The other one that you need to be aware of is that expenses are usually from the office to the destination, not from your home. And the same thing with travel time. It is the estimate of the travel time from how long it takes to get from your place of work, not your home, to wherever you're going. And you should also know, maybe just to be fair to some people, is that you can play this out a little bit in the sense that when you're doing overseas travel, if you look under travel directives, there are a bunch of rules in place about if it's over a 9-hour flight, whether or not you're allowed to upgrade and so on. I personally, you can play that game. I personally recommend you don't. Just take the lowest economy fare, keep it clean. You're paying for taxpayers' money anyway. You may as well spend it legitimately, etc. On per diems, this is really super important. Don't assume that the per diem that your organization has is the same as what's allowed in the travel directory. Also, if you're not sure what a travel directory is, go Google it. Write down in your notes from this website. Go Google travel directives, and you'll find a published travel directory, and per diems vary from country to country and even from within a country. Like if you go to Nigeria, the travel directory difference between Abuja and between Calabar, they're completely different amounts of money for breakfast, lunch, and dinner, and for staying in a hotel. They've already figured it out. And you cannot charge more than the given travel directory. And yes, your auditor is going to look at it. They're definitely going to look through that. So you thought you were allowed to spend $150? Well, you're not. You have to go and it'll be $139.20. They figured it out to that level of per diems. In kind. I've written at the very top of this one, you can win on this one because in kind is are ways in which, okay, the basic idea with in-kind is that for many contribution agreements that you're supposed to put in a proportion of cash to prove that Canadians love you and that you're legitimate and so on, and the government is contributing to something and you're doing it together. Or if it's a grant, you might, usually grants, you don't have to have any of this, but in a contribution agreement, you have to either show cash or you show in-kind. Now, if your in-kind is quite a bit, let's say you get $1 million from the government and you're going to do 15%, you've got to come up with $150,000, and you said you're going to do it in in-kind. You can't just say, yeah, my friends all help me, it's all good. You cannot. The rules on in-kind have changed many years ago, and for most in-kind, you have to have an in-kind record or show something. Now, the problem is that your Chartered General Accountant, the CPAs don't recognize in-kind. They don't, there's no real way to track this. So the rules are really open here. As to what constitutes in-kind and what doesn't. And so the way, after many arguments about in-kind that I've had with auditors, this is all opinion too, because this stuff changes. This is super fluid. But generally, what you can do is you can say with a professional, let's say a nurse decides that you're gonna send a volunteer who's a nurse to go work in your project for a month. And the nurse is normally paid, I don't know, maybe they're paid $80,000. I don't know what's a nurse paid these days. Any idea? Okay, let's just pretend that a nurse is paid $60,000 a year. You divide that, that's $5,000 a month, right? No, that's $10,000. No, that's $5,000 a month. Yeah, that's $5,000 a month. Yeah. So you can now say that the value of sending her is $5,000 a month. And this can really vary. Like if you send doctors or you send people that are lawyers or you send people that are professionals, those rates can even be a daily rate. Or if you can show that the consultant that you're hiring to go do something is going to do something for free, but they normally charge $800 or $900 a day, all you got to do is prove that. So you get the consultant to write down my daily rate is $900 a day, and I'm going to go for 10 days and visit your project. That's $9,000 of in-kind. It adds up really, really quickly. And I would highly recommend that you document it, not rely later on trying to find the person to prove the amount of money. So I used to keep an in-kind binder when I had to do in-kind projects. And every time somebody did something in-kind or volunteered, even if they stepped in the office and your board members hold a meeting, that's in-kind. So you just keep documenting in-kind and it can really add up to astronomical amounts of money in very little time. The other one that's really a good idea is, let's say somebody wants to give you something. Let's say you're going to go buy something. You're going to buy a car. And the car dealer says, I'm going to give you 50% off. Well, you don't just pay the 50% price. Say, could you please write on the receipt that you gave me 50% off, and write that as in-kind donation. So you can do this with consultants all the time. They're giving you deals because you're a nonprofit. Ask them to write the deal down on the piece of paper to acknowledge it, because that's your proof later with the accountant that you did get that 50% of that cost was actually in-kind. Finally, I'll just be really careful about exaggerating in-kind. Don't do that. You don't need to. If you do this properly and you're running a decent shop, a nonprofit, you're going to have so many volunteers and people giving you in-kind all the time that you're going to rack it all up and realize, wow, it's going to be the opposite of needing to fake it. You can actually very quickly prove that your organization gets tons of in-kind time. So don't put in stuff that's not fair market value. And fair market value is the value of the item that was donated. So let's say people donate you a car. It's actually a piece of crap. It's only worth $500, but you wrote it down as a $10,000 Chevy. Don't do that. Write down the actual fair market value and blue book it, or do something that's going to prove the value of it. You can do that by a Craigslist. Oh, keep going. Okay. 15 minutes. Keep going. So what do? I got to hit. Tricks to surviving. Okay, I am getting close to the end. Take a deep breath and have a mental stress practice. I highly recommend getting a dart or something of the photograph, and you just throw darts in your spare time after the auditor leaves. Do not get irritated with the auditor. They're just doing their job. Be nice to them. Use decoys. This is a classic. That auditor is there to spend a lot of time and to make you suffer. That's my theory on this. So what I would do is I have things that I know as a decoy. I know I've got a paper trail on that one. But I'm not going to say that straight away. I'll say, yeah, I got to go search for that. And then I'll go fret and I'll go do other things. And they think that I'm fretting and they're doing their job. And everybody's agreeing we're playing the game. In the end, I know I got a perfect paper trail. I bring them the paper trail. It was a decoy from the very, and I don't tell them. Don't tell anybody I do that. And don't do it yourself. Haha, I think you should do it. The point here is that the auditors coming in, they're expected to do their time. And it takes a certain amount of time to do an audit. If your audit is too clean, it's too good, then they have to figure out ways to bill. So now you're looking at going down trails that you don't need to go down. So hold a really clean shop, have an audit binder, put them in the cramped room. Don't socialize with them. Don't take them out for lunch. Make it an enjoyable experience, or they're going to stay, right? So you want to kind of make life miserable for your auditor, but not too miserable, and then run a clean shop, and then have enough things for them to do that they can bill their time and get paid. Okay, and then let them go at the end, and keep it all very professional. This bit about the binder, I highly recommend you do this right now. Think to yourself, I'm going to go get an audit binder. Get a nice big blue audit binder, yay thick, and put the contract in it, and then put your policies in it, and then put every single time that you have an email from a project officer that has anything to do with money or agreements, you're going to print it out, because later on, you're going to be sitting there with the auditor and you go, I know that project officer said I could do that, but you can't find it or whatever. So just get in the habit of printing out every time a project officer agrees to something, print it out, put it in the audit binder. And then have a timesheet binder and print out all your timesheets, make sure they're all signed, and put them in the audit binder. And everything's ready for the auditor to come. And when the auditor comes, you let them talk and so on, then you hand them the binder, you put them in the cramped room, and they're already going to have more confidence in you because you are ready. You're ready to go with them. I don't let employees, I learned this one the hard way, don't let anybody have a good time when they're here. Don't be nice, be professional, but don't ever think that auditor is nice. Like seriously, we've had some super nice people come in, audit, and they turn out they really go in for your blood later on. So, and they're not going to let on. They're coming in, they're doing their job. So I've learned to treat them exactly the same way. Super professional, but I'm not your friend, and you're not my friend. End of story. And also, maybe I'll just tell a little story on that one, because I went through an audit once where the auditor was just being unbelievable, like unbelievable. And I had just been audited by a different auditor, and they were super nice, and nothing went wrong. So a different auditor comes in, it's like, what's your problem? Like, the other previous auditor didn't want that. We get into this argument, blah, blah, blah. Days go by, and they want a lot of money back. And finally, the auditor says, well, what do you guys actually do? Tell me about, and I started telling them stories about what we actually do. Here, because the example was Sierra Leone, and they're like arguing about, well, why don't we have a bank reconciliation? And at the time I was working in Sierra Leone, it's the middle of a war zone. All the banks are actually destroyed because they've been blown up. It's very hard to get a bank reconciliation report when you're walking in with $10,000 cash strapped to your stomach. So the idea is I go in, and we're spending money under difficult conditions, and they have never set foot in Africa. They have no idea that the taxi driver who's driving a motorbike doesn't have a receipt book, right? And so you didn't have receipts, but you knew you spent the money legitimately, blah, blah, blah. We're arguing about all this. He got a better picture of what we do. And it can be important at the very beginning that you sit your auditor down, explain to them the nature of what you do so they get on side with your purpose as a nonprofit. I think it's quite important to set the tone, especially if you're working in difficult countries where the context is different from what an auditor in Canada who's never been in a third world country or a developing world country before, they just don't realize that life is very, very different, and that the expectations around receipting and so on can be completely different. How am I doing for time? I feel like I've been talking long. I need some water. Okay. Some more suggestions. Think in terms of months, not weeks, when planning an audit. Don't think that it's going to be done real quick. Put aside funds or a percentage of overhead and collect it, and expect that you're going to have to spend 1% of your money back. You're going to have to give it back in disallowed expenses. I know I'm being harsh there, but 1% would be very, very low. I'm told 1% is a miracle audit. For those of you who've gone through with 0%, I bow down. You are amazing people. That's incredibly rare. Much higher percentages are much more, like I've seen 10% of the money wanted back. That's a lot. You're into a real pickle if they want that money back. So what you could do is you could plan, especially if you're going to do a whole series of projects and you're deep in with an auditor, a funder, you could say, okay, let's take 1% of that money aside and keep putting it aside for when they do the audit expenses. So take 1% of your overhead or whatever, put it aside, put it into a fund, save it. You're going to have to spend it. Talk to your board of directors, have a very frank conversation with them. A lot of board of directors have never been through an audit, and they need to realize that an audit is about this game of disallowed expenses, and it's not your bad management. Sometimes it's just differences in expectations or how you actually report on things. Negotiate the period of your audit so you don't ruin your summer holidays. You don't have to do an audit the day they say. You can say, look, you're allowed to audit. I'm not going to stop you from auditing, but you don't need to do it on July the 14th when everybody's on holiday. You can come back in September. So try that. Do your best. And finally, that one, ask for a midterm audit. Beg for a midterm audit so that you can figure out whether you're doing things right. Because if you get a midterm audit and they do disallowed expenses, you can agree to the disallowed expenses, and then you can figure out ways to get your money back. Getting out of jail options. This is kind of like that old Bob Dylan song, you know, if you steal $5, you know, they'll put you in jail, but if you steal $1 million, they'll make you king. There's sort of a bit of truth to that, and that's that if you get into a big enough problem with your funder, it's also their problem, because why did they let you get that far? So they're going to be scrambling if you've done, and you can say that to them. You can say, look, you're trying to disallow $20,000 worth of expenses. Why didn't you let us know that this is not allowed a lot earlier in the game, or that this is not proper? So play the game on both sides there, in the sense that they're not supposed to let you get into trouble. And I've seen some organizations actually fold in Canada. I can name 3 off the top of my head that folded because of audits. So keep that in mind. Don't blow whistles and say you're going to go to your MP or you're going to get mad and all that. Do not do that until the very, very last second, because that's not going to bode well for you. The audit is a process of negotiation. The original audit results are merely the recommendations from the auditor. You still get to negotiate with your project officer, finally with your funder, finally with the compliance unit, and then eventually, if you still don't agree, you can go to the trouble of complaining politically, but I don't recommend that. I've seen people do that and get bit really hard on it. I also would recommend that you negotiate on the big ticket items and don't sweat the small stuff. If you've got a few small items, just pay them. It's a disallowed expense. If you didn't keep track, admit it. And concentrate on making sure that you didn't screw up on the really big, like the timesheets and the travel expenses and so on. Make sure that you've got your policies in place before you get into trouble on those ones. And then finally, just to say that the one thing I've learned over the years is that the more open and transparent you are with everybody about your books, then the less likely it is that you're going to have a skeleton or a problem. And like, to give you an example, I'm really open about books. Like, people know here, the employees know they can come in and they can look at the books. And if you can't explain an expense, you know, morally and ethically to your own people, then you're going to have a hard time explaining it to an auditor. So the trick is to ask yourself, will you let people look at your books right now, go through them and check them? And are you completely open with your CPA, or are you trying to hide things? If you're trying to hide things, you're probably going to get caught. So just don't. You know, that's kind of the trick, and run a clean, honest shop and you'll be fine. If all else fails, you're in trouble. You're better off paying for the disallowed expenses and maintaining the relationship of trust, because everybody's allowed to make mistakes. You can pay the $10,000 back or whatever, and then score another project, than to refuse to pay the money, because what they can do, and they will do this, is they will freeze your ability to get funding from any other source associated with government. So you don't agree with Global Affairs. They want $10,000 back. You refuse to pay. Well, they freeze Environment Canada. They freeze all the other folks that you could get funding from, and you can't get any federal funds. And eventually they'll come for you. So you're kind of screwed. Just pay it. An example of ways that you can get your money back through clever means. I mean, I don't really want to go into this in too much detail because I don't think it's a good practice, but there are ways that accountants and auditors have shown me. These are not even my ideas. This is an auditor saying, well, do it this way and you'll be fine. So an example is, you send people off to a meeting in Nigeria, and the published travel directory for Lagos is $300 a day for accommodation. Super high. And your employees, they're allowed to spend $50 a day, for example, on private accommodations. That's pretty standard. Most of them, if you stay at a friend's house, they'll give you $50. Well, let's say you got 6 employees and they all do a meeting, and each one's allowed to get $50 back. You could pay your employees, and then the employees can just donate the money back to your organization as an independent donation. And you can see that all the time. You could actually pay them legitimately, or let's say a person wants to donate a venue. You say to them, well, no, if you want to donate the venue, can I please pay for the venue, $300? And then you make a $300 cash donation to our organization. Now, it's all clean, it's all legitimate, and it's all above board. But you never paid for it, and the money came back. It's $300. You take the $300, you spend it on whatever you need to spend it on to pay back your debt or whatever from your previous audit. You see how there's these little tricks. What I'm getting at is, if you play those, just make sure that they're actually legal, legitimate, and above the board tricks, and then you're cool. You'll get your money back and call it a day. Another one, what is it we got here? Yeah, project. I've already talked about rental costs. I'm not going to go into that. So finally, to wrap this whole thing up, where are we? 3 minutes. That I think this is pretty self-explanatory. This idea of money being a vector. Read that 7 Laws of Money. It's a great book. There's more than one way to build trust besides the money path. I think that if you're actually open and honest with your project officer and you communicate a lot, then you're not going to get into trouble because you've got a trail, a written paper trail on your communications. And then I think I've already said this, that I kind of view our work in the nonprofit sector that if you can't justify it, like if you can't ethically justify what you're doing as if you were a taxpayer, then maybe you should get audited and you should lose sleep. But, you know, like our last BCCIC audit, completely clean. And it's because if you run a clean shop, then there's nothing really to worry about. Do this stuff properly and don't get defensive and don't worry about the audit. And if you have a niggling worry and it's because it's about something unknown, then get your CPA or your bookkeeper to give you an honest assessment about how you can run it better. And after that, there's nothing else you can do. Like you just try to run a good shop and they're going to come and they're going to audit and they're going to check. And hopefully, you know, they're going to, if they find something, they'll be negotiable if you're running an open and clean shop. That's about it, you guys. I could talk forever on audits. I think we'll just stop there. I'll hit stop share. And I got a question and then we'll, what does it say? Can you read it? I can't see it.
Do you have advice on exchange rates?
Oh, exchange rates. I didn't say much about that. Yeah, I do. So this is how that works. You send money over. Let's say typically if you're working, and let's just take a country like Nigeria where I did a lot of work, you're going to send over $50,000, okay? And the Naira, the local currency, is going up and down like a yo-yo. Now the question is, what did the actual expense cost? Now what they do is they average, the auditor will come in and they have access to what are called historical exchange rates on the day of the expenditure. So let's say that you spent $10,000 on, let's say you bought a truck. You bought a truck in Nigeria, it cost you $10,000. It didn't cost you dollars, it cost you Naira. And you have a receipt for the Naira. Well, the question is, what are those Nairas actually worth in Canadian dollars? And it's varying so much, the auditor has to decide when. On large expenditures, what I would do if I were you on a large expenditure is I would document the historical exchange rate on the day of the expenditure, put that in as a notation to what the Naira was worth. Otherwise, what they're going to do is they're going to take the time period between the day of the advance and the day of the report. So let's say the Naira was worth 62 Naira on the day that you sent the advance, and it's worth 100 on the day that you sent the report. They're going to say the average historical price or value of the Naira was 80 or 90, and you're going to lose or gain on the currency exchange, and there's nothing you can do. And to an enormous amount of money. Again, by deep. So what you can do, some clever tricks here. One is that you can have a U.S. domicile account because the U.S. dollar is very stable. What you can do is you can send your money to the foreign country, put it into the U.S. account and hold it. And then on the day that you have the expenditures, you can actually make the exchange rates. And then you can document the exchange rate for that day or the day of the expenditure. The account will allow that. They absolutely will allow that. I know they'll do that. Otherwise, you can play the exchange rate out to your advantage by noting, like if you know that the Naira or the local exchange is generally going down and getting worse, then you know that if you send money later in the game, you're going to win, right? So you could send $50,000, but send it at the very end of the advance period. Is that getting a little too, it's getting a little complicated, but what you can do is you can ask your CPA about this. Just mental note for those of you who are going to follow this. Exchange rates can add up to thousands of dollars because basically what happens is you send money on one day and then the expense takes place on another day. Maybe the Naira is different. Well, that all just went into ether. It all just went into the exchange rate. I mean, it's really hard to figure out what happened to that money. And essentially you either lost or you gained. And in some cases you'll gain like $1,000 bucks, or in some cases you'll lose 1,000. And the auditor has to average those. And then they put it in under an account in their report called currency loss exchange. And it can add up. That's a big subject, by the way, very interesting subject. It's one where you can really play with your money if you get any good at it.
Cap it off.
That's cap it off. Okay, that was our rant. That was a lot of talking. I hope that was useful to you guys. And again, just the disclaimer, I mean, bang on our button here thing and make sure that you're absolutely clear that anything that I just said is my opinion only and does not replace the good advice that you'll get from your chartered accountant, and it in no way replaces the your funder, which is the ultimate person to listen to. And they will argue against a lot of the things that I've said, I'm sure, and say I'm completely wrong, in which case they're right and I'm wrong. Hope you guys enjoyed that, and we covered lots of territory. Goodbye.